right now, ERCOT, that's the operator of the fiercely independent Texas power grid, they have a waiting list that is just so overwhelmed by artificial intelligence companies begging for electricity that they literally had to create a VIP line.
Yeah, a velvet rope.
Exactly, a velvet rope just to filter out the phantom projects. The queue to plug into the Texas grid has become so, saturated with speculative tech money that regulators initiated what they call a batch zero process.
Which is fascinating. I mean, it's unprecedented.
Right. It is a VIP desk for serious infrastructure. And today, for you listening, we are looking at a legacy regulated utility company that just walked right up to that VIP desk and dropped 45 gigawatts of demand onto the table.
And it is a volume of power generation that fundamentally reshapes our understanding of industrial growth.
Yeah.
I mean, we are talking about a single company fundamentally pivoting its entire century-old operating model.
Yeah.
They're pivoting to become the physical bottleneck for the global artificial intelligence arms race.
And that is exactly what we're dissecting today on this deep dive. Because this is Talk Tickers, and our mission here is always to cut through the Wall Street jargon and give you, the retail investor, the actionable truth. We're breaking down the Q2 2026 earnings call of American Electric Power.
Ticker symbol AEP.
Ticker symbol AEP, exactly. And we're taking our standard approach today. We're going to be completely data forward. We are stripping away the corporate fluff to get to the underlying mechanisms of what they are actually building, right?
Right, how they're financing it. And, the big question whether this stock is the ultimate backdoor play into the AI boom.
Exactly. So here is our roadmap for the deep dive. We're hitting 4 pillars. First, the headline numbers. Second, the story behind those numbers. Third, management's forward guidance. And finally, the bottom line, whether we are bullish or bearish.
Sounds like a plan.
But before we get to the 45 gigawatts in Texas, we have to address the elephant in the room. Because I was looking at the headline numbers when this transcript dropped, and the immediate optics are, well, they're messy.
Yeah. Messy is an understatement if you're just glancing at the top line feed on Bloomberg Terminal.
Let's lay out the raw data for the listener. So, for the second quarter of 2026, American Electric Power reported operating earnings of $1.36 per share. That's $742 million in total.
Right.
But that $1.36 is actually a direct contraction from the $1.43 per share they reported in the exact same quarter last year, Q2 of 2025. You have a 7-cent year-over-year drop.
Which sets off alarm bells for a lot of people.
Totally. Now, zooming out slightly, year-to-date operating earnings are up a bit. $3.01 per share versus $2.98 for the first half of last year. And their regulated earned ROE, their return on equity, is holding at 9.2%.
Which I should point out is perfectly aligned with their forecasted expectations for the end of the year, despite that isolated second quarter contraction.
But I have to push back on that second quarter contraction right away. Because as an investor, if you are pitching me a hypergrowth AI thesis, and the very first print I see is a negative year-over-year earnings comparison,
you're going to be skeptical.
My immediate instinct is to look for operational leakage. I mean, Wall Street algorithms are ruthlessly unforgiving to top-line shrinkage. So if this company is supposedly experiencing unprecedented demand, how on earth are we looking at a 7-cent per share deficit in Q2? Are they bleeding money?
Well, no. And this is exactly why we rely on the transcript and not just the headline ticker, right? Because the high-frequency trading algorithms see the 7-cent drop, they initiate a sell-off, and they completely miss the context.
Okay, so what's the context?
If you dig into the underlying accounting architecture of the quarter, which was outlined by their chief financial officer, Trevor Geiger, you realize you're looking at an optical illusion.
An illusion?
Yeah, it is not an operational failure at all. It's a structural artifact created by 2 highly specific timing-related items.
Okay, let's break down the mechanics of those items in plain language, starting with the biggest driver. The CFO explicitly pointed to a 2025 transmission minority interest sale as the primary culprit for the comparability issue.
Right.
Now, I understand capital recycling generally, but walk us through how carving out a minority stake distorts the year-over-year view for a massive utility holding company like this.
Sure. So it basically comes down to ownership math. Utilities are arguably the most capital-hungry entities in the public market.
Oh, absolutely.
They are constantly pouring billions of dollars into steel, concrete, copper, just to maintain baseline service, let alone grow. So to fund that endless capital expenditure without constantly, issuing new shares and diluting their equity base, they engage in capital recycling.
Makes sense.
Right. So in June of 2025, AEP monetized a minority interest in their transmission business. They basically sold a slice of that specific subsidiary to a partner in exchange for a massive infusion of upfront cash.
So in Q2 of 2025, AEP was still recognizing 100% of the earnings from that transmission business on their consolidated income statement.
Precisely. Fast forward to Q2 of 2026, and the overall pie of that transmission business has actually grown. The physical assets are generating more revenue.
Right, but they own less of the pie.
Exactly.
Yeah.
AEP's retained slice of that pie is mathematically smaller because they now have to back out the minority partner's share of the net income. So the underlying asset is performing brilliantly, but the accounting mechanics of year-over-year comparability make it look like a contraction on a per-share basis.
And the CFO made a fascinating point regarding that specific dynamic. He noted that because they are aggressively plowing that recycled capital back into new rate-based transmission infrastructure, they actually project that the transmission segment will flip back.
Yeah, flip back to positive.
Right, to providing a favorable year-over-year earnings contribution by the end of 2026. The new growth is going to aggressively outpace the slice of income they surrendered in that stake sale.
It is a textbook execution of a capital rotation strategy. Right. I mean, you sell a stabilized, mature asset at a premium valuation, and you reinvest the proceeds into high-growth, high-return infrastructure projects that compound over time.
Which creates a temporary valley.
Exactly. It creates a temporary valley in the earnings trajectory, but the long-term slope of the curve steepens dramatically.
Okay, that addresses the structural anomaly, which clears up a lot. But what was the second timing-related item dragging on that $1.36 print?
So that was an income tax timing disparity, and it was isolated within their corporate and other accounting segment. The CFO highlighted timing-related items tied to the consolidated impacts of their effective tax rate.
I want to stop there because effective tax rate timing impacts sounds incredibly opaque to the average retail investor.
Oh, it's purely Wall Street jargon.
Right. So in corporate finance, tax timing usually implies the exhaustion of tax credits or maybe a shift in depreciation schedules. How does this specifically impact a regulated utilities quarter?
Well, utilities have highly complex tax profiles because they carry massive deferred tax liabilities. That's mostly due to accelerated depreciation on their infrastructure.
Okay.
And sometimes the actual cash recognition of certain tax obligations or, the realization of specific renewable energy tax credits, well, it hits in a different calendar month or quarter than it did in the prior fiscal year. It's really just a pure cash flow timing mismatch.
So it's not a permanent impairment to their annual earnings power?
Not at all. In fact, Trevor explicitly stated that these tax impacts are fully expected to reverse themselves by the fourth quarter. When you look at the full 12-month fiscal year, the tax impact is just a wash.
Okay, so synthesizing the headline numbers for you listening, that 7-cent drop is phantom weight. The market algorithms might have choked on it, but the structural reality is a business that deliberately rotated capital last year and had a tax bill hit a month late this year, which means we can cleanly move past the optical distraction and focus on the actual growth engine here, because that's our part two, the story behind the numbers. And the demand pipeline numbers they disclosed in this quarter are, frankly, staggering.
Staggering is really the only appropriate word. I mean, I have analyzed utility earnings transcripts for over a decade, and the volumetric figures AEP is currently discussing are entirely unprecedented in the modern era of the American grid.
Right. So the CEO, Bill, reported that AEP successfully contracted an incredible 6 gigawatts of new load in the second quarter alone. 1 quarter.
3 months.
3 months of business development, resulting in 6 gigawatts of signed physical demand.
To put that into perspective for the listener, for the past 20 years, utility load growth in the United States has been essentially flat, oscillating around a mere 1% annual growth rate.
Just flatlining.
Yeah, because we gained efficiencies in HVAC systems, we transitioned to LED lighting, and heavy manufacturing largely migrated overseas. Utilities were fighting tooth and nail just to keep their baseline demand from shrinking. A single gigawatt was a massive multi-year strategic win.
And now they have 6 in 90 days.
Right. Now you have one company locking down 6 gigawatts in 90 days.
I look at that number and I want to contextualize the sheer physical footprint of a gigawatt.
Okay.
We throw the term around in relation to data centers, but translating that to the retail landscape, a single gigawatt is roughly the equivalent of the power required to run 750,000 average American homes.
Wow.
So AEP essentially added the electrical equivalent of 4.5 million homes to their contracted pipeline in a single quarter.
And this brings their total contracted load to an eye-watering 69 gigawatts through the year 2030. That's up from the 63 gigawatts they disclosed during the Q1 call.
So the velocity of the demand accumulation is actually accelerating.
Accelerating rapidly, yeah.
And this demand is aggressively concentrated. It's not distributed evenly across their multi-state territory. Let's look at the geographic footprint, because this is where the AI thesis really crystallizes. Out of that 69 gigawatts, 12 gigawatts are slated for Ohio, which is a major traditional hub. But the overwhelming bulk 45 gigawatts is targeted squarely at Texas, operating specifically on the ERCOT grid.
Texas has just become the epicenter of the global hyperscale data center build-out. I mean, the combination of cheap land, a relatively permissive regulatory environment, and proximity to massive wind and solar generation has made it the default destination for AI infrastructure.
But 45 gigawatts is an unfathomable amount of power to inject into a single state's grid over a 5-year period. Which brings us back to that VIP line concept we teased in the intro.
Right, batch zero.
The transcript specifically notes that this 45 gigawatts in Texas is Senate Bill 6 compliant load, and that AEP formally submitted it into ERCOT's batch zero process. So let's dissect the mechanics here for the retail investor. First off, what does Senate Bill 6 compliance actually mean for the infrastructure?
So Senate Bill 6 was a massive legislative response in Texas to the grid failures we saw during Winter Storm Uri a few years ago.
When the grid almost collapsed.
Right, exactly. The state realized they needed to heavily incentivize dispatchable generation.
And dispatchable means?
It means power plants that can turn on instantly, like natural gas, regardless of whether the sun is shining or the wind is blowing. A load being Senate Bill 6 compliant generally means it aligns with the state's stringent new reliability metrics and funding mechanisms.
Okay.
These are designed to ensure the grid doesn't collapse under the weight of this massive new industrial demand. It's essentially a stamp of regulatory approval that this demand isn't going to destabilize the system.
And that ties directly into the batch zero process. If you have compliance, you get to jump the queue.
Exactly. The ERCOT interconnection queue, which is just the administrative waiting list to get a new project wired into the high voltage transmission lines, is notoriously backlogged. Because the barriers to entry were historically so low, developers would just throw speculative projects into the queue just to hold a spot.
Creating a ton of phantom demand.
Tons of it. ERCOT could not decipher which data centers were fully funded and ready to build, and which were just shell companies hoping to flip the permit to someone else.
So the queue is entirely clogged with vaporware.
Right. So ERCOT restructured the entire framework. They created a batch process. And batch zero was designed exclusively for highly mature, hyper-credible projects that are physically capable of coming online between now and 2032.
So you have to prove you're real.
Yes. It requires significant financial commitments and advanced engineering studies.
And AEP's management walked in and dropped 45 gigawatts of projects onto the desk for batch zero. The sheer capital required to support that level of generation and transmission is just mind-bending. Which brings us to the most aggressive financial metric in the entire call, honestly.
The CapEx plan.
Yeah. To support this 69 gigawatt pipeline, AEP's 5-year capital plan spanning 2026 through 2030 has been expanded to $78 billion.
It is a capital expenditure profile that rivals the defense budgets of small nations.
And the CEO deliberately highlighted a historical comparison that puts it into stark relief. He said just 4 years ago, their rolling 5-year capital plan was $38 billion.
So they doubled it.
They have fundamentally doubled the size of their infrastructure spending pipeline in 48 months.
And this is where we really have to shift our thinking away from the digital abstraction of artificial intelligence and confront the brutal physical reality of the technology. You cannot run a hyperscale training cluster on elegant code alone.
No, it runs on physical hardware.
It requires concrete substations, thousands of miles of heavy-duty aluminum and copper transmission lines, massive step-down transformers, and incredibly complex cooling systems. That $78 billion is not going into software development. It is going straight into the dirt.
And I have to pause right here and channel the deep skepticism of a seasoned retail investor. Because when I hear a company announce a $78 billion capital expenditure plan tied to a massive new technology wave, my immediate thought is capital destruction.
Like the dot-com era.
Exactly. We saw telecom companies dig thousands of miles of trenches during the dot-com bubble to lay fiber optic cable for demand that didn't materialize for another decade. The companies went bankrupt, and the shareholders were completely wiped out. So if these tech companies are caught up in an AI arms race, what happens if they are just reserving phantom power they might never actually use?
It's a huge risk.
What if the algorithms become significantly more energy efficient? Isn't AEP's management taking a massive existential gamble that could leave their shareholders holding the bag for tens of billions of dollars in stranded assets?
That is the single most critical bear thesis you could construct against this stock, 100%. If the 69 gigawatts of demand is a mirage, the $78 billion capital plan is a financial suicide mission. But, and this is crucial, this is where the transcript provides the ultimate bulletproof defense.
How so?
Because AEP is fully aware of the dot-com telecom bust. They're not taking the tech companies at their word, and they're certainly not building this infrastructure on spec.
So how are they actively mitigating that demand risk? Like, what is the contractual reality on the ground for this power?
They're neutralizing the risk through aggressive, legally binding financial structures. The CFO explicitly stated that in just the last month alone.
Wait, just 1 month?
In just one single month, AEP collected nearly $2 billion in hard cash and collateral strictly to secure the ERCOT load commitment.
Let me make sure I am interpreting that correctly for our listeners. $2 billion in actual cash sitting in AEP's accounts handed over by the tech companies just to prove they're serious.
Exactly. It represents the required credit support for the full 45 gigawatts submitted to the Batch Zero process. And the protection goes much deeper than just an upfront deposit, too.
What else are they doing?
The CEO detailed that they are securing this unprecedented demand with fully executed take-or-pay electric service agreements, or ESAs.
I really want to spend some time on the mechanics of a take-or-pay contract in the context of utility regulation, because I think it's the linchpin of the entire bullish argument here. How does this actually function legally?
Well, it is the ultimate downside protection mechanism in project finance. A take-or-pay contract means the hyperscaler signs a binding legal agreement guaranteeing that they will pay for a specific, massive volume of electricity every single month for a decade or more.
Regardless of usage.
Regardless. If their artificial intelligence data center is running at 100% compute capacity, they pay for the power. If the AI bubble bursts and their data center is sitting completely empty and gathering dust, they still pay AEP for the exact same amount of power.
So the entire volume risk is legally transferred away from the utility shareholder and placed squarely onto the balance sheet of the technology company.
Completely. And you have to consider the counterparty quality here. We are not talking about thinly capitalized startups.
We're talking about the Mag 7.
Exactly. The entities signing these take-or-pay contracts are the most heavily capitalized, cash-rich technology monopolies in human history. They're in such a desperate existential arms race for AI dominance that they're willing to absorb 100% of the infrastructure risk just to guarantee they have the electricity when they actually need it.
It is a phenomenal competitive moat. AEP gets guaranteed, locked-in revenue streams funded by trillion-dollar market cap tech giants. But this brings up a massive political and regulatory friction point.
The ratepayers.
Yeah, the everyday ratepayers. If I am a retail customer living in Ohio or Texas, and I read in the newspaper that my local utility is embarking on a $78 billion spending spree to build infrastructure for Silicon Valley data centers, my immediate assumption is that my residential power bill is about to skyrocket to subsidize Microsoft or Google.
Which is a totally fair assumption.
Utilities are heavily regulated monopolies. They cannot just spend $78 billion without permission from the state. How is AEP navigating the local political blowback from everyday people?
So, historically, your assumption would be perfectly accurate. Massive utility capex cycles usually result in painful rate hikes for the residential base. But the CEO outlined a dynamic in this transcript that completely inverts that historical precedent. This massive corporate growth is actually acting as a deflationary force on residential power bills.
Okay, you are going to have to walk me through the math on that, because spending $78 billion while simultaneously lowering costs sounds like accounting magic.
I know it does, but it comes down to a deep understanding of utility cost allocation and the nature of fixed costs on a power grid. Think about the power grid, like a massive multi-lane toll bridge.
Okay, a toll bridge.
The capital required to build the bridge, maintain the steel, and pay the toll operators is a fixed sunk cost. If you only have 10 commuter cars driving across that bridge every single day, the toll for each of those commuters has to be astronomically high just to break even on the maintenance.
Right, because the small base of users bears the entirety of the infrastructure burden.
Exactly. Now imagine a massive fleet of thousands of heavy commercial semi-trucks starts using that exact same bridge every single day, and they're willing to pay premium commercial tolls.
But
the total revenue generated by the bridge skyrockets. The fixed costs of maintaining the bridge haven't changed proportionally, but now those costs are distributed across a massively expanded revenue base. The bridge authority can actually slash the toll price for the everyday commuter cars and still generate record profits overall.
So in this scenario, the hyperscale data centers are the fleets of semi-trucks. They are pulling such an immense continuous volume of power off the grid that they are disproportionately absorbing the fixed costs of the entire system.
Precisely. The CEO noted that as they model out this 69 gigawatt pipeline, AEP is projecting up to $16 billion in fixed cost offsets, specifically benefiting residential customers within their vertically integrated utility territories.
$16 billion in systemic costs that everyday ratepayers suddenly do not have to shoulder.
Yep. And management emphasized that this isn't just a long-term theoretical projection. It is a mechanism they are executing right now in real time. They highlighted that they have already received regulatory approval for a planned base rate reduction in Ohio, and they're actively preparing to file for another base rate decrease in Indiana later this summer.
I want to underscore how wild that is from a macroeconomic perspective. We are sitting in an environment where inflation has battered the consumer for years, right? And a massive utility monopoly is walking into a state commission and voluntarily filing for a rate decrease.
It's unheard of.
The political capital they are generating with that move must be astronomical.
Oh, it creates an incredibly frictionless regulatory environment. You have to remember, utility executives spend half their lives arguing with state public utility commissions, the PUCOs, begging for permission to raise rates to cover costs. It's inherently adversarial.
It's always a fight.
But when AEP walks into a hearing room in Indiana and says, "We have a plan to attract billions in tech investment to the state, create thousands of construction jobs. The tech companies are fully collateralizing the risk. And D, we are firmly requesting to lower the monthly power bill for your voters," the politicians are absolutely ecstatic. The adversarial relationship just evaporates.
And the transcript actually noted that strong relationship in Indiana. State officials are actively pointing to AEP as the premier example of how to support aggressive corporate economic development while simultaneously driving affordability for the local constituency. It is a masterclass in stakeholder alignment.
It really is.
And that regulatory tailwind extends far beyond just Ohio and Indiana. They discuss a series of highly favorable regulatory settlements across their footprint. Let's look at Oklahoma for a second. They filed a settlement there that includes something called an enhanced transmission cost rider. We definitely need to translate their regulatory jargon. What is a rider, and why is it superior to a traditional rate case?
Sure. So a rider is a highly specialized regulatory mechanism that dramatically accelerates a utility's cash flow. In the traditional utility model, if AEP builds a new transmission line, they spend the money up front. Then they have to wait, sometimes for years, to initiate a massive, exhaustive rate case.
Opening the books to everyone.
Right. They have to open their books, endure months of audits and public hearings, just to get permission to gradually recover the cost of that specific transmission line from customers over the next 30 years. It creates a massive lag between spending the capital and earning a return on it.
Which traps their capital and degrades their real-time return on equity?
Exactly. A rider, however, allows the utility to carve out specific types of investments, in this case, new transmission infrastructure, and recover those costs much more dynamically, almost in real time, through a dedicated line item on the customer's bill.
So they don't have to wait.
Right. They don't have to wait for a sprawling rate case.
Yeah.
If they spend the money on approved transmission, they can adjust the rider and begin recovering the cash almost immediately. It significantly reduces regulatory lag and stabilizes their cash flow profile.
And there was a fascinating exchange during the Q&A portion of the call regarding that exact Oklahoma settlement. An analyst named Michael from Barclays dialed in and pointed out that as part of the settlement that secured this new transmission rider, the state actually lowered AEP's authorized return on equity from 9.5% down to 9.375%.
Right. Slight haircut.
On paper, a drop in authorized ROE sounds like a defeat. How did the CFO defend that concession?
Well, Trevor's response highlighted the pragmatic reality of utility regulation.
Yeah.
He basically confirmed that they accepted a slightly lower theoretical ceiling on their profit margin in exchange for the certainty and velocity of the rider mechanism.
The velocity of cash.
Exactly. In the complex give and take of a regulatory settlement, securing a mechanism that guarantees you actually collect your cash quickly is vastly more valuable to the balance sheet than fighting to maintain a slightly higher theoretical ROE that gets ground down by years of regulatory lag.
It is the ultimate preference for cash flow certainty over optical margin. And they also detailed another massive financial maneuver, this time in Virginia, a $1.4 billion securitization executed in May. We see securitization used constantly in the mortgage and auto loan markets, but how does a utility utilize it, and why should you, the retail investor, care?
Okay, so in the utility sector, securitization is a financial tool used explicitly to manage massive unexpected cost spikes that would otherwise cripple the ratepayer.
Give me an example.
For example, if a utility suffers catastrophic infrastructure damage from a hurricane, or if there's a historic spike in global natural gas prices, they incur billions in sudden costs. Normally, they would have to finance those costs using their standard corporate debt, which carries a relatively high interest rate, and then pass that expensive debt burden onto the customer.
Which triggers extreme political blowback.
Right. No politician wants that on their watch. Securitization bypasses that entirely. The state legislature passes a law allowing the utility to issue special, dedicated bonds to cover those extraordinary costs.
And what backs those bonds?
Crucially, these bonds are backed by a legally guaranteed, non-bypassable charge on every single customer's future power bill. Because the state is essentially guaranteeing the repayment through legislative fiat, these bonds receive a AAA credit rating and carry an incredibly low interest rate.
So they are essentially taking expensive, high-interest corporate debt and refinancing it into ultra-cheap, state-backed debt purely to lower the carrying cost.
Exactly. And the CEO explicitly pointed out that this $1.4 billion securitization enabled their Virginia subsidiary, APCO, to file for its lowest base rate increase request in nearly 3 decades.
Wow.
Once again, they're utilizing complex financial engineering to suppress customer rates, which in turn keeps the regulatory commissions highly supportive of their broader $78 billion growth agenda.
It's all connected, and they are not just relying on state-level securitization to lower costs, they are aggressively tapping federal government subsidies too. The transcript highlights an enormous influx of Department of Energy capital.
Yeah, the scale of federal support they're accessing is remarkable. AEP Texas recently secured a DOE loan guarantee for up to $3.3 billion, specifically to finance 2,800 miles of new transmission projects within the ERCOT grid.
So the federal government is acting as the guarantor for the debt required to build the AIS structure. What is the tangible financial benefit of that guarantee?
Well, because the debt is backed by the federal government, the interest rate is significantly lower than AEP's standard cost of capital. Management estimates that this single $3.3 billion DOE loan guarantee will deliver $685 million in direct financing savings.
Which again flows straight through to lower costs for the end customer.
Yep. And across their entire corporate portfolio, AEP has aggressively secured roughly $5 billion in DOE loans and nearly $400 million in direct federal grants, driving an estimated $1.4 billion in total customer benefit.
It is a brilliantly constructed financial ecosystem. I mean, think about it. They have $2 billion in hard collateral from the tech giants protecting the downside. They have take-or-pay contracts ensuring long-term revenue. And they are utilizing fixed cost offsets, state-level securitization, and federal DOE loans to relentlessly drive down residential rates, creating an impenetrable political moat around their growth strategy.
That is the comprehensive story behind the numbers. It is not just about raw demand. It is about engineering a corporate structure that can safely absorb and monetize that demand without triggering a regulatory revolt.
Which brings us perfectly into part 3, management guidance. With this labyrinth of downside protection and federal support firmly established, how is the executive team actually forecasting the financial future of the company? Because this is where the divergence from traditional utility expectations becomes truly stark.
The confidence emanating from the executive team in this transcript is palpable. I mean, despite the optical Q2 earnings contraction we dissected earlier, management made the aggressive decision to actually raise their 2026 full-year guidance.
They didn't just maintain it. They bumped the expected range up by a full 10 cents, establishing a new target of $6.25 to $6.55 per share. As an investor, you know that executive teams do not raise full-year guidance in the middle of a complex capital cycle unless they have absolute ironclad visibility into their back half cash flows.
It is a massive signaling mechanism to Wall Street. But honestly, the more important metric is their long-term trajectory. They reaffirmed an annual operating earnings growth rate of 7 to 9% and explicitly stated they expect an EPS AGR.
That's a compound annual growth rate on their earnings per share.
Right. They expect an EPS CAGR of greater than 9% straight through to 2030, driven directly by that $78 billion capital plan.
I really want to contextualize what a greater than 9% compounding growth rate means in the heavily regulated utility sector, because it completely shatters the historical paradigm.
Historically, a high-quality, regulated utility might model out a 4%, maybe a 5% compounding growth rate in a highly optimistic scenario.
They're built to be slow.
Right. They are designed to be slow, lumbering dividend vehicles. Yeah. But a 9% compounding growth rate fundamentally alters the mathematical trajectory of the company. At a greater than 9% CAGR, the core earnings power of the corporation is essentially doubling roughly every 8 years.
That is software as a service level growth. It is tech level compounding, but it is masquerading inside a regulated utility trench coat.
Exactly.
However, executing a $78 billion capital plan to achieve that 9% growth requires threading a microscopic needle when it comes to the balance sheet. If they take on too much debt to fund the transmission lines, the interest expense will completely cannibalize the earnings growth.
Balance sheet management is the hidden operational risk in this entire thesis, and management spent a significant portion of the call addressing it. They noted they are rigidly targeting an FFO to debt ratio in the 14 to 15% range.
Okay, let's define a CFO. It stands for Funds from Operations. It is essentially the pure, unlevered cash flow generated by the core business before depreciation and accounting adjustments. So the FFO to debt ratio is a direct measure of their ability to service their massive debt load out of current cash flows. Right. And I want to push on that specific 14 to 15% target range. In a normalized zero interest rate environment, a utility might comfortably float closer to a 13% ratio. But with a macroeconomic interest rate environment currently sitting where it is and a $78 billion CapEx pipeline looming on the horizon, why is management so aggressively defending that specific 14 to 15% band?
Because that specific band is the dividing line for the major credit rating agencies. Moody's and Standard & Poor's watch utility FFO to debt metrics with absolute ruthlessness.
They don't mess around.
No, they don't. For a regulated utility holding company, maintaining a ratio between 14 and 15% is the mathematical sweet spot required to defend a strong Tier 1 investment-grade credit rating.
And you, the retail investor, need to understand exactly what happens if they slip below that line. If AEP gets over-leveraged, if that ratio drops to 12%, and S&P downgrades their credit rating from, say, a BBB plus down to a BBB or even into junk territory, what is the systemic consequence for the $78 billion plan?
It would be catastrophic. A credit downgrade immediately triggers a spike in the interest rate premium they have to pay every time they issue new debt in the bond market.
And they are issuing a lot of debt.
Exactly. When you are planning to issue tens of billions of dollars in new debt to fund substations and transmission lines over the next 5 years, a mere 1 or 2% increase in your borrowing costs translates to billions of dollars in evaporated shareholder value.
The interest expense would completely consume the 9% earnings growth.
Yep. By rigidly defending that 14 to 15% FFO to debt ratio, the CFO is explicitly protecting the profitability of the entire AI growth thesis.
So they have to fund the $78 billion, but they are severely constrained in how much raw debt they can issue. This leads us directly into one of the most sophisticated financial maneuvers disclosed in the entire transcript. To bridge the funding gap without breaking their credit metrics, the CFO announced the successful execution of a $3 billion forward equity transaction, intentionally structured to settle by May of 2028.
That was a brilliant move.
Let's dive into the mechanics of a forward equity sale, because it is a genius piece of corporate de-risking. How does it differ from a standard secondary stock offering?
Okay, so if AEP executed a standard secondary offering today to raise $3 billion, they would immediately issue millions of new shares into the open market, dilute the ownership stake of every existing shareholder, and take the cash today.
But they don't actually need all $3 billion today.
Exactly. They need it spread out over the next 2 years to pay construction invoices as the transmission lines are built. If they took the cash today, it would just sit on the balance sheet, earning a low yield, creating a massive drag on their return on equity.
Right. You are diluting the stock today for cash you don't need until tomorrow. It's wildly inefficient.
Exactly. A forward equity transaction solves this elegantly. AEP goes to large institutional investment banks and executes a binding pre-sale. They say, we will sell you $3 billion worth of our stock at today's market price. However, we are not going to physically issue the shares to you, and you are not going to hand over the cash until May of 2028.
I look at that structure and I immediately see the de-risking element. They have pre-secured the $3 billion in equity capital. They absolutely know they will need to execute the capital plan. They have perfect funding visibility. They avoid paying interest on debt, and they prevent immediately diluting the stock today.
It's a win-win-win.
But let me push back on the strategy for a second. By locking in the sale at today's stock price, aren't they capping their potential upside? If the market realizes AEP is the ultimate AI proxy and the stock price doubles by 2027, they are still forced to sell those shares in 2028 at the old, cheaper 2026 price. They are sacrificing massive potential equity value.
That is the precise opportunity cost of the maneuver. You're exactly right. Yes, they cap their upside on that specific $3 billion tranche of equity, but in the utility sector, management teams do not gamble on future stock prices when funding critical infrastructure.
They can't afford to.
Right. The utility model prioritizes the absolute certainty of the cost of capital over speculative upside. By executing the forward sale, Trevor removed the risk of a massive market crash in 2027, disrupting their ability to fund the $78 billion build-out. The cash is guaranteed to appear exactly when the construction bills come due.
It is the ultimate prioritization of operational certainty over financial speculation. But securing the capital is only half the battle. You can have all the cash in the world, but if you cannot physically acquire the hardware, you cannot build the grid. And this brings us to an operational strategy that absolutely blew me away when reading the transcript.
This supply chain stuff.
Yes. The CEO, Bill, spent a highly disproportionate amount of time detailing their aggressive procurement and supply chain strategy, specifically regarding heavy industrial equipment.
And this is perhaps the most underappreciated dynamic of the entire AI infrastructure boom. We are currently facing an unprecedented global supply chain bottleneck for physical electrical equipment. The entire world is attempting to electrify simultaneously.
That's a global crunch.
Europe is frantically rebuilding its energy infrastructure to pivot away from Russian natural gas imports. Developing nations are modernizing their grids. And in the US, we are layering this historic data center build-out on top of an aging electrical system.
And the manufacturing base simply cannot keep up.
Not even close. The wait times for specialized high-voltage electrical transformers have stretched from a historical average of a few months to, in some cases, 3 to 4 years. The physical hardware is becoming the ultimate pacing item for the technology sector.
And this is where AEP is flexing its massive scale to create a structural competitive advantage. The transcript states that AEP has proactively secured 13 gigawatts of gas-fired turbine generator capacity through the year 2031, executing massive contracts with primary suppliers like Pronova and Mitsubishi.
They're essentially cornering the market on heavy generation equipment.
They are treating these multi-million-dollar industrial turbines like rare commodities. I mean, if a hyperscaler approaches a competitor utility and says, we need power for a massive new training cluster, that competitor is forced to look at the supply chain and admit, we would love to build you a power plant, but we can't secure a turbine until 2030.
Right.
AEP, however, can walk into that same negotiation and say, we already own the manufacturing slots, we have the turbines locked down, we can have you online by 2028.
In the artificial intelligence arms race, speed to market is the single most valuable currency for these technology companies. They are burning billions of dollars a month trying to outcompute their rivals. AEP's proactive procurement strategy transforms a sluggish utility procurement process into a razor-sharp competitive weapon.
And it gets even more aggressive. An analyst from Morgan Stanley, David, specifically questioned management about their extended supply chain strategy. The CEO revealed that beyond the 13 gigawatts locked in through 2031, AEP has also secured formal options for up to 10 additional gigawatts of turbine capacity, stretching all the way through 2035.
10 more gigawatts.
Right. But I have to ask about the risk profile of those extended options. Are they legally obligated to take delivery of 10 gigawatts of turbines a decade from now, regardless of what the macroeconomic environment looks like?
No, and the CFO was very careful to clarify the contractual nature of those agreements. They are strictly options, not binding purchase commitments. AEP has secured the right, but not the obligation, to step into those manufacturing slots at Pronova and Mitsubishi if the AI demand continues to compound at its current rate.
So it's essentially a massive call option on the continuation of the AI boom. But what if the thesis breaks? What if by 2032, quantum computing or radically more efficient algorithms collapse the power demand of the hyperscalers, and AEP is left holding these massive turbine options?
That is where the strategy reveals its true brilliance, because it serves a dual purpose. The CFO noted that the timeline of those 2035 turbine options perfectly aligns with AEP's internal schedule for the forced retirement of their own aging legacy coal and early generation gas plants. If the AI demand miraculously evaporates, AEP simply exercises the turbine options anyway and uses the new, highly efficient gas turbines to replace their retiring coal fleet, ensuring baseline reliability for their standard retail customers.
It is a flawlessly engineered, heads I win, tails I don't lose scenario. They secure the critical hardware required to dominate the AI growth cycle, but the downside risk is completely absorbed by their baseline operational requirement to modernize their own fleet. It is highly disciplined, deeply asymmetrical capital allocation.
And that level of strategic creativity extends beyond just procurement. During the Q&A session, the analysts aggressively probed management on alternative, non-traditional structures being deployed to serve these hyperscalers. An analyst from Wells Fargo specifically focused on AEP's exploration of something called a GENCO structure, particularly in the state of West Virginia.
Let's unpack the regulatory mechanics of a GNCO, because it represents a fascinating workaround to the traditional utility model.
Wow.
What exactly is a GNCO, and why are the tech companies pushing for it?
So, GNCO is an industry acronym for a generation company. Let's look at the standard utility rate basing process. Historically, if a utility wants to build a new power plant, they have to undergo a brutal regulatory gauntlet.
The CPCN process.
Right. They must file for a CPCN, a Certificate of Public Convenience and Necessity, with the State Commission. They have to publicly prove that the new power plant is absolutely necessary for the general public good, debate consumer advocacy groups, and justify pushing the capital cost of that plant onto the monthly bills of millions of retail ratepayers.
Sounds like a nightmare.
It is a highly politicized process that routinely takes 3 to 5 years before a shovel even hits the dirt.
And 3 to 5 years is an eternity in the tech sector.
Exactly. The hyperscalers are telling the utilities we cannot wait half a decade for a state commission to debate the public necessity of our data center. We need power now, and we are willing to pay for it entirely out of our own pockets.
Which is where the GENCO comes in.
Right. A JNCO involves establishing a legally distinct, often unregulated or separately capitalized generation entity that exists completely outside of the traditional utility rate base.
So it completely bypasses the public CPCN process because the cost isn't being subsidized by grandma's power bill.
Precisely. The hyperscaler signs a direct bilateral power purchase agreement with the GNCO. The tech company funds the capital. The GNCO builds the specialized power plant exclusively for that single data center, and the state regulators generally stay out of the way because the retail ratepayer is financially shielded from the project.
Management is looking into this.
The CEO, Bill, stated on the call that AEP finds the GNPO structure very intriguing and that they are deeply engaged in analyzing its deployment. He specifically highlighted West Virginia, noting that the state's governor has established aggressive economic development mandates that align perfectly with deploying these fast-track, privately funded generation structures to lure tech capital to the state.
It is the privatization of the grid build-out, facilitated by the utility. He also discussed another fascinating tactical approach to speed to market. An analyst from Wolf Research pressed him on the deployment of bridging strategies. What does a bridging strategy look like in the physical world?
A bridging strategy is an engineered workaround to the transmission construction bottleneck. Imagine a hyperscaler secures a massive tract of land in Ohio and immediately needs 500 megawatts of power to begin training a new model. But AEP looks at the grid and says, we can only pull 50 megawatts off the existing lines at that specific location today. Upgrading the high-voltage transmission lines to deliver the full 500 megawatts will physically take 3 years of construction.
So the data center is basically stranded?
Historically, yes. But with a bridging strategy, AEP offers a hybrid solution. They say, we will give you the 50 megawatts from the grid today to get your initial servers online. Simultaneously, we will install localized modular power generation directly onto your property, often utilizing highly advanced natural gas fuel cells to generate the remaining 450 megawatts on site.
Wow.
This bridges the power gap for the next 3 years while we finish constructing the permanent high-voltage transmission lines.
And the transcript specifically referenced a major project utilizing Bloom Energy fuel cells as a prime example of this bridging capability. It is an incredible level of bespoke engineering and customer service. I mean, they are no longer operating like a sluggish monopoly dictating terms to a captive audience. They are acting as aggressive, highly creative energy consultants for the largest companies in the world.
Exactly. It's a totally different mindset.
But it hasn't all been frictionless execution. To provide a balanced view, we have to look at the macro-level grid friction they're encountering. An analyst from True Securities brought up some highly publicized, ongoing tension between AEP and PJM. We need to clearly define what PJM is because it is a critical piece of the Eastern U.S. power architecture.
Right, so PJM Interconnection is an RTO, a regional transmission organization. They are effectively the air traffic controllers for the wholesale electricity grid across 13 states in the eastern U.S., encompassing critical AEP territories like Ohio and West Virginia.
So they don't own the lines, but they manage the traffic.
Correct. PJM doesn't own the power lines, but they govern the market mechanics, the dispatch of power plants, and crucially, the interconnection queue that dictates who gets to plug into the macro grid and who pays for the necessary systemic upgrades.
And during the Q1 earnings cycle, AEP management was highly vocal about their frustration with PJM. The transcript from earlier this year highlighted 3 massive points of friction: grid governance, the agonizingly slow speed of internal interconnection approvals, and broader resource adequacy concerns. AEP essentially felt that PJM was bureaucratically paralyzed and completely failing to adapt to the velocity of the AI demand shock.
It was a very public, very tense standoff between a massive utility and its primary grid operator. But what was fascinating about this Q2 call was the radical shift in tone. The CEO struck a highly conciliatory, deeply optimistic posture regarding PJM. He noted that the pace, intensity, and productivity of their direct conversations with PJM leadership had increased exponentially.
He specifically referenced a major comprehensive technical conference that took place just a week prior to the earnings call on July 23rd.
Yes, and he expressed strong confidence that they are rapidly coalescing around a set of systemic solutions. The critical breakthrough seems to be centered on cost allocation. AEP wants a rigid framework ensuring that the entities causing the massive need for systemic grid upgrades, namely the hyperscale data centers, are the ones who bear the financial cost of those macro-level upgrades, protecting the integrity of the broader market.
So the data centers pay for the upgrades.
Right. And the fact that the CEO is now publicly praising PJM's responsiveness indicates that even the most massive, historically slow-moving grid operators are finally waking up to the reality of the AI demand curve and restructuring their processes to accommodate it.
Let's touch on 2 final, highly specific operational updates discussed on the call that validate this rapid execution thesis. Management provided updates on the Piketon transmission opportunity in Ohio and a highly unique fuel cell project in Wyoming. Regarding Piketon, the CFO stated they expect to have fully executed binding documents signed by the third quarter, at which point that massive project will be officially rolled into their updated 5-year capital plan. But the Wyoming project really caught my eye because of the contractual nuances.
The Wyoming project perfectly encapsulates AEP's obsession with downside protection. They are partnering with a hyperscaler to deploy a massive fuel cell installation in Cheyenne, Wyoming. However, there is a hard, federally mandated deadline to have this specific infrastructure installed and operational by the end of 2028 in order to qualify for massive investment tax credits.
And the CEO noted they recently had to amend the foundational agreement because the hyperscaler requested some timing accommodations. Now, normally, if a client delays a project, the contractor absorbs the financial pain. How did AEP structure the amendment?
They structured it so that AEP is entirely financially insulated from the delay. The CEO explicitly stated that the amended agreement protects AEP financially for any timing accommodations requested by the client.
That's huge.
Furthermore, the contract dictates that if the specific site in Cheyenne encounters insurmountable zoning or environmental hurdles, the hyperscaler is contractually obligated to deploy those AEP-procured fuel cells at an alternate location.
So again, the risk of stranded assets or dead capital is zero. AEP holds all the leverage. If the tech company needs more time, AEP gets paid for the delay. If the site fails, the tech company has to find a new site for AEP's equipment. It highlights an extreme flexibility built on top of absolute ironclad downside protection.
It is a contractual architecture designed by a management team that fundamentally understands the leverage they currently hold over the technology sector.
Which brings us to the culmination of this deep dive, part 4. The bottom line. We have stripped away the optical illusion of the Q2 earnings contraction. We have unpacked the sheer physics of a 69 gigawatt demand pipeline and the batch zero VIP line in Texas. We have explored the $2 billion in hard collateral, the take-or-pay contracts transferring the risk to the hyperscalers, and the $16 billion in retail cost offsets creating a frictionless regulatory environment. We analyzed the 9% compounding growth guidance, the $3 billion forward equity de-risking strategy, and their aggressive move to corner the global market on gas turbines.
When you lay the mechanics out sequentially like that, it is a staggering volume of data points, all pointing in a singular direction.
So synthesizing this mountain of structural, financial, and regulatory data into the talk tickers framework, what is the definitive, actionable verdict on American electric power?
The verdict is unequivocally aggressively bullish.
Let's crystallize the actionable takeaway for the retail investor listening to this. Why are we slapping a hyper-bullish label on a company that, for the last 50 years, was considered the most boring, conservative equity in the stock market?
Because the entire fundamental paradigm of what a utility represents has been violently disrupted over the last 24 months.
It's a new era.
Traditionally, retail investors viewed regulated utilities purely as bond proxies. You bought them for a safe, highly predictable 3 or 4% dividend yield, and you hoped the underlying stock price would slowly creep upward in line with inflation. They were defensive safe havens. You parked your capital in utility when you were terrified of macroeconomic volatility.
But AP's financial profile no longer resembles a bond proxy in any way.
Not even slightly. Through aggressive capital recycling, proactive supply chain dominance, and brilliant regulatory engineering, AEP has secured tech-level earnings growth rates, forecasting greater than 9% compounded annually, straight through to the next decade. But crucially, and this is the entire thesis, they are capturing that explosive tech-level growth without inheriting the existential volatility, the cutthroat competition, or the catastrophic downside risk of a traditional technology stock.
And that is the ultimate differentiator. If you buy shares in an incredibly hot software startup or an AI chip designer, a competitor could invent a slightly more efficient algorithm or a denser silicon architecture tomorrow morning, and your investment is instantly rendered obsolete.
Right. The moat in software is incredibly shallow.
But nobody is going to wake up tomorrow and invent a competitor to the physical high-voltage power grid in the state of Ohio. It is a natural, legally protected monopoly anchored in concrete and steel.
Exactly. AEP possesses an impenetrable, state-sanctioned regulatory moat, and the unprecedented growth they are experiencing is being driven directly, explicitly, and irreversibly by the global artificial intelligence and hyperscale boom.
So this is the actionable takeaway for you, the investor, whether you are currently holding this stock or if you are looking at your portfolio right now and realizing you are dangerously overexposed to the wild, gut-wrenching swings of semiconductor manufacturers and AI software platforms. If you want direct, high-leverage exposure to the massive, undeniable tidal wave of the artificial intelligence data center build-out, but you want to sleep soundly at night, knowing your investment isn't going to gap down 30% on a missed earnings whisper number, AEP offers a fully collateralized, regulatory-protected, defensively engineered backdoor entry into the AI boom.
They are literally being paid in advance, in hard cash, by the richest technology monopolies in human history to construct the physical infrastructure of tomorrow.
It's wild.
And they are executing this unprecedented build-out using financial engineering that actually lowers the monthly utility bills for their everyday residential customers, thereby guaranteeing the unwavering support of the state politicians and regulators. It is, without hyperbole, a flawlessly executed corporate strategy.
It is the ultimate picks and shovels play for the 21st century. During the gold rush, you didn't buy the prospectors, you bought the guys selling the shovels. Today, you buy the company selling the gigawatts.
It really is the most asymmetric risk-reward profile I have seen in the infrastructure space in my career.
Which brings us to the close of our deep dive. We have unpacked the accounting, the physical pipeline, the regulatory strategy, and the financial guidance. But before we sign off, I want to leave you with a final, highly provocative thought. Something to deeply consider as you allocate capital across the broader technology landscape. We just spent a significant amount of time meticulously breaking down the operations of one single regional utility holding company. American Electric Power is a massive corporation, yes, but it is ultimately just one localized puzzle piece comprising the broader American electrical grid.
Just one piece.
And just to keep pace with the localized AI demand within their specific geographic footprint, this one company has been forced to secure contracts for 69 gigawatts of new power generation. They have been forced to double their capital expenditure plan in 4 years, committing $78 billion. They are aggressively hoarding gas turbines on the global market and legally locking down billions of dollars in cash collateral just to manage the sheer physics of the demand shock.
The physical scale of what one company is attempting to build is almost incomprehensible when extrapolated across the entire sector.
Exactly. So here's the question you have to ask yourself. If one regional utility is experiencing this level of chaotic, concrete, and steel demand shock just to plug these data centers into the wall, what does this mean for the macro velocity of the global technology race? For the last year, Wall Street has been fiercely debating the ultimate bottleneck for artificial intelligence. Analysts argue over whether the limiting factor will be the manufacturing yield of advanced silicon chips, or the availability of pristine training data, or the sophistication of the software algorithms themselves.
But maybe it's none of those.
Right, because looking at the brutal math inside this AEP transcript, looking at the sheer brute force physical reality of what is required to simply turn those algorithms on, is it possible that the ultimate, inescapable bottleneck for the entire future of human technological advancement isn't digital at all? Is it possible that the single greatest limiting factor for artificial intelligence is simply going to be the sheer physical availability of old-fashioned heavy metal electricity? It is a muddy, complex, deeply physical landscape out there. Think about it.